SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-Baffi Bocconi Meet the Authors lecture. The trigger for today's lecture is a new book by John Cochrane, Luis Garicano, and Klaus Masuch on Crisis Cycle, Challenges, Evolution, and Future of the Euro, which was published earlier this summer. The euro has survived crises unimagined at its founding. Financial meltdown of 2007-2009, sovereign debt crisis of 2010 to 12, the pandemic, the energy crisis following the Russian invasion of Ukraine. The ECB fought these crises with far-reaching policy innovations, buying up sizable amounts of mostly government debt and providing large loans to banks. This has raised expectations that the ECB will intervene routinely. Crisis Cycle recounts this history and asks whether the far-reaching emergency tools and measures taken by the ECB were within its mandate and might have created negative incentives, discouraging sound national fiscal policies and unpopular structural economic reforms. Crisis Cycle then also offers recommendations for restoring a durable monetary union. We are happy and honored to have with us today two of the book's co-authors, John Cochrane, Senior Fellow at the Hoover Institution and Professor at Stanford University, and Klaus Masuch, former Principal Advisor at DG Economics of the ECB. Following this, SUERF Honorary Member Peter Praet, former ECB Chief Economist, and a leading voice on monetary, financial, and European matters, will moderate a panel with two outstanding discussants who he will introduce then, and with the authors. Without further ado, over to you, John and Klaus.
We agreed that I would go first. So there's our beautiful cover and our three co-authors. There's sort of three quotes in the book that encapsulate a lot of it. Whatever it takes from Mario Draghi, because it is France, Jean-Paul Juncker, about why you can ignore debt and deficit limits, and we are not here to close spreads. A wonderful statement from Christine Lagarde that lasted about 10 minutes. So what we're going to do, I'm going to do a little introduction overview and the founding architecture of the euro. Klaus will tell you about the details of how things fell apart in the four crises, and then our ideas on how to fix things. So how was the euro set up? Despite many people's recitations of the contrary, a currency union without a fiscal union and without a political union is perfectly possible and perfectly sensible. In fact, Europe had one for 1,000 years, gold coins, which were the common currency, and there was certainly no fiscal union and certainly no political union for much of that time. But if you're going to have a currency union without fiscal union, you have to solve the free rider problem. There's a temptation for an individual country to borrow too much, discover it can't pay it back, and come running to the ECB to say, print money, bail us out. That's already a problem for a single country like the US, but 22 times that problem if you have many countries. Now, the people who set up the euro were smart. They figured out this was a problem, and so they set it up admirably to contain that problem, especially when you think about the 1990s and how few advanced country sovereign debt crises anybody had ever seen. But naturally, with a few lacunae that then caused problems. A series of crises erupted, and in emergency actions, those constraints were broken. Which is, you gotta do what you gotta do in a crisis. But in between the crises, the member states and the EU institutions didn't reform to make sure that that sort of thing didn't happen again. And as a result, the unwelcome incentives, that's the polite version of the temptation to borrow too much money and come running to the ECB to get bailed out, remained in place. And that makes further intervention more likely. Just like bank runs, when you bail out ex post, then there are incentives to take too much risk ex ante, and unless you bottle up the moral hazard, you get bigger and bigger crises. That's where we are. The problems have built up, so this ad hoc system is in danger of a serious and chaotic failure, and perhaps our friend France is in charge of beginning that serious and chaotic failure. Let us hope not. Our point, reform is possible. It's not that hard. It's economically straightforward. We're not politicians. And perhaps we have one last chance to put this genie back in the bottle. A disclaimer, in case you get our purpose wrong. We think the Euro and the EU are great institutions, and our book is devoted to preserving, maintaining, and improving them. There are lots of people who say, oh, the Euro is terrible, the EU is terrible. That's not us. We offer economic analysis. There's a lot of morality plays. Did someone break some law? Did someone break the treaty? We're not there. We're simply going to look at what happened economically and make no claims about legal structures. And this is not a morality play. Well-intentioned people did the best they could in difficult circumstances. So we are not criticizing the crisis action. Surely all of us think, oh, if we could only go back in time, we could do it better. But that was not the central problem. The problem was the lack of reform after crises, not the expedients taken in the crisis. So how was the Euro set up, the founding architecture? Again, monetary union can be perfectly happy with no fiscal union, no political union, and monetary and fiscal policy have to be separate to contain that incentive to borrow too much money and then ask the central bank to fix it. How was the Euro set up to deal with that problem? First, the ECB was set up as completely independent, but independence comes with a limited mandate, and the ECB's mandate was very limited. Price stability, period. And every mandate is not just here's what you should pay attention to, it's here's what you should not pay attention to, anything else. The ECB would not do monetary financing. It wouldn't buy sovereign debts. There were going to be debt and deficit limits for member states, so that even though we said the ECB wasn't going to buy out your debt, we'll make sure you don't get in trouble in the first place. And a no bailout clause, there wouldn't be fiscal help either from other states. This founding structure was enhanced by the first decade's experience, in which ECB monetary policy contributed to sort of set the norms as well as the rules of the founding philosophy. The ECB creates new money by lending to banks. Other central banks buy assets. The ECB created new money just by lending to banks in the first instance. And its communication was very clear. We're not going to support member states. The interest rate target went in, it worked. The single mandate worked. Inflation was low, hallelujah, until 2007. But that founding architecture was understandably incomplete. What were the lacunae we talked about? You can have a currency union without fiscal union, but you must countenance sovereign default. Countries are, in the end, like corporations, at least as a fallback option, last resort option. It must be possible that sovereigns default. If they can't default, as even a fallback option, that means the ECB is printing money to bail them out. And the treaty was really silent about this delicate question in several important ways. There's no corporate sovereign bankruptcy or restructuring procedure. There's no crisis resolution mechanism, a way to get temporary help along with conditionality, as the IMF offers internationally and as regular bankruptcy law offers to companies. The interaction of the financial system was particularly unfortunate. The regulatory system, as well as the practice in banks, treats sovereign debt as completely risk-free. You don't have to hold capital against it. So banks naturally hold large concentrated portfolios of sovereign debt, and they become hostages. Any default or restructuring brings down the banks. So even if it would be fairly straightforward on a sovereign basis, the financial system is a hostage. And related, there's no banking union. If there were more banking union and common regulation, then internationally diversified banks would be much less exposed to sovereign trouble. Now, this was natural. We're not criticizing. It's amazing what they did when they put the euro together. But you're trying to get 20 independent countries to sign on to something difficult. As I said in other places, it's sort of like really negotiating hard the prenuptial agreement on your wedding night. Well, you can do it, but it's not going to be a pleasant wedding night. And so that's naturally what, of course, we're all going to behave. We're not going to talk about what will happen when you default on your debt. Heavens no, no one's going to do that. Of course, that's how you do things. We'll figure that out later if we have to, and that's natural. All constitutions are pretty general, and then with the weight of experience, you figure things out. Well, now we have to. The central story here is how that founding architecture, rather than learn from the crises and be reformed, eroded. So let me give a brief overview and then Klaus will jump in. What happened? Right away, France and Germany broke the debt and deficit rules because it is France. Then the financial crisis came, the sovereign debt crisis, the low inflation stagnant QE era, COVID, war, energy. In each one of these, the ECB bought larger and larger quantities of sovereign debt with fewer and fewer restrictions. It propped up asset prices, it subsidizes banks. The idea of the banking reform to keep the banks out of, to stop being hostages, people kept talking about it, but it never happened. And banks still hold large, concentrated public debt portfolios with zero risk rates. Where we are now, the ECB holds a very large portfolio of sovereign debt, and it's widely expected to stop any sovereign spread from rising, even to levels that were accepted before. So countries don't see market incentives to borrow less, spend wisely, implement growth-oriented microeconomic reform, which is really Europe's greatest challenge. We talk about money and interest rates and so forth, but the slowdown in European growth is the most important thing for Europe in general, and not number one for paying off its debts. So I think here's where Klaus will take over.
John just talked about worsening of institutions in a sense of policy decisions were taken, incentives were created, expectations were created, which worsened institutions. What do we think are good institutions in this perspective? Monetary fiscal, a clear separation of monetary fiscal policies, and strong incentives for the other players, for fiscal, for economic policies, and then for bank regulation to do sound policies. And these good institutions would unburden the ECB. In the following chart, we show in red where institutions worsen, and we show in blue that it can happen that reforms improve institutions. What John briefly outlined a minute ago is in the red arrows. In the beginning, on the left side, in the end, up to now, on the right side, just mentioning that there were, after the sovereign debt crisis, a few years, 2 or 3 years, where good reforms were done. This is the blue part, and we discussed all this I think in a fair way in the middle part of the book. There were reforms which go in the right direction, but the problem is then after, say, 2013-14, after the SSM was set up, most expectations of further reforms did not come true, and even the reforms which had been implemented, like the fiscal compact and many other things, were watered down. The BRRD banking resolution reform, I mean, was apart from one event in Spain, was never applied. So you have a lot of reforms, a lot of hope, which also gave Mario Draghi and the Governing Council reason to think that OMT, whatever it takes, would go in the right direction. But then in the last 10 years, I would say the reforms went mostly in the wrong direction. There were no reforms, apart from NGU on the right side. And now I'm zooming in on two aspects of these worsening and improving of expectations of institutions, namely government bond purchases by the ECB of individual bonds, not the QE, the big type, and of the debt restructuring or delayed debt restructuring in Greece. The first, you see on the left side, worsening of expectations was that Greece was fully bailed out without any upfront debt restructuring. You can read in the IMF documents that the IMF staff thought that Greece was certainly not sustainable in its debt dynamics with high probability. And the IMF made so clear that it was a European decision not to have a debt restructuring upfront in Greece. But that, of course, set wrong expectations for the future. The main reason was, we discussed several reasons in the book, of course, contagion risk. But one thing is important, these contagion risks mainly come down if you had bailed in Greek bonds early on, not only Greek banks, which were at the time full of Greek bonds, but also German, French bonds, which held a lot of Greek bonds, and also other bonds of other more possibly fragile sovereigns would come under stress. So the problem was not that there's contagion from government to government. The problem was that the banks held so much bonds of Greece and other possibly troubled member states, that it was very, very difficult to do what should normally have been done, namely an early debt restructuring in Greece. But that means that the decision to have monetary union without putting any risk weight in bank regulation on sovereign debt, that this decision showed to be very painful. The burden put on the Greek society in form of tax increases, in form of pension cuts and wage cuts, that was much larger because there was no early swift debt restructuring. And that is the indirect consequence of having no risk weights on sovereign bonds in bank balance sheets, so which meant that the Greek debt restructuring would have had contagion to banks, at least in the perspective of many people. Now we have two in blue, and one remark on S&P. Just 1 or 2 weeks after the Greek program, the first Greek bailout program was agreed by the IMF board and the Eurogroup, the ECB started to buy bonds of Greece, Ireland, and Portugal without any conditionality, just to calm down the market, without any conditionality, certainly not decided by member states. And then in the blue part, we have an improvement of expectations. Finally, 2 years later, there was a debt restructuring in Greece. And surprise, surprise, it went very well from a technical point of view. No, it was a very complicated undertaking, but it was implemented, and there was a major haircut above 50% on Greek bond holdings of private entities, of banks, and so on. But it came too late, so the program had to finance, the IMF estimates, roughly 50 billion of bonds until the Greek debt restructuring were paid back at 100 by, and this payback falls, of course, on taxpayers in the end. It was financed by the program. Shortly after, Mario Draghi announced whatever it takes, and there was OMT. And OMT is much different from S&P, which was in a crisis setting. OMT says the ECB only steps in if there is a program from the ESM. 10 years later, things worsen again in terms of institutional quality. TPI was implemented to support prices of bonds of troubled sovereigns without any ESM program. So TPI took away what OMT had done in a positive manner. We understand why TPI was announced. It was the need to increase interest rate sharply. Inflation had run away way higher than the target of 2% in early 22, spring 22, and the ECB had to increase rates. And in order to avoid that there will be huge spreads going up, something had to be invented. And for some reason at that point, OMT was not seen as appropriate. So OMT was not used, and something new was put up. And Lagarde in the press conference made very clear, I think 2-3 times, that this is a discretionary decision alone of the governing council in its sovereignty. There's a lot of input from the Commission, from the IMF, and possibly, Commission, IMF, and other ESM on debt sustainability and on fiscal rules. But in the end, it was very clear it's a sovereign decision of the governing council. And then contrast this with 10 years before OMT. A necessary condition for the ECB even to consider OMT purchases is an effective conditionality attached to an appropriate ESM program, meaning the Governing Council in 2012 had the perspective that the ECB doesn't want to be the only game in town. It had to weigh that the politically sensitive issues, a program, bailout or not, should we have upfront debt restructuring, was all decided by member states. The member state in this trouble would ask for the program, then a decision is made what conditionality is possible, whether an upfront debt restructuring is possible, and all these parts were outside the ECB. And only if the program started to be implemented and the member states, the fiscal authority, put money on the table, then the ECB would consider to come and support this program with purchases. And that's a big difference. Draghi mentioned this in the press conference, and a few months later, there's a wonderful speech where Draghi made very clear that this precondition of a program is there and the crucial element to preserve the monetary policy independence of the ECB. And he even made clear that without these assurances that there's a program, there is a certain and a big risk, I would say, that supporting sovereign debt bond prices would mutate into financial subsidies for unsustainable policies. I would recommend everybody to read that speech again. I don't think you can say that this is no longer true now. Unfortunately, I think TPI was set up in an asymmetric manner. The ECB did not say if, say, spreads or financing conditions are too low relative to fundamentals, we would start selling bonds of these countries. The ECB just said we would consider buying bonds if spreads are too high relative to fundamentals. And of course, if it's asymmetric, you create the possibility that TPI, even if it's not used, would push down spreads below fundamentals. And now here is the key problem. Not going for the OMT solution, but going for the TPI solution means that the ECB effectively assumes responsibility that I would say in a democracy are normally assigned to parliaments. The ECB itself has to assess whether the country concerned with problems has sound and sustainable fiscal policy. The ECB has to assess whether tensions in the markets are not or are due or not due to fundamentals. And consider what this means. The ECB would have to say, should we put the full burden of a high debt or the debt overhang only on the taxpayers, the citizens and the workers, or should some of the burden be put on bondholders? This decision is now de facto in the hands of the ECB. There is no normal procedure. The country has no incentive to go to the ESM and the IMF and say, oh, we want a program, and then the ESM says, perhaps we do an upfront debt restructuring, because the ECB most likely will intervene. The ECB would have to assess whether the plans and the promises of the government can be trusted, but this is a highly political assessment. It's not just a technical thing, and more so, that sustainability is a long-term concept. We would even have to assess, the next election and the election after, would there still be people, the electorate voting in majority a parliament that would do everything to pay back bondholders in full, even if this implies at the time large hardship for the citizens. That's not a purely technical assessment. That's a highly political assessment, and the ECB cannot escape it under TPI because it said it's its own decision. Even without actual purchases, TPI may be squeezing default premium spreads below fundamentals, and that can, of course, lead to the problems which John has discussed. I spoke mainly about programs of the ECB, S&P, OMT, TPI, which is designed to help individual countries with fiscal troubles or high spreads. Now here we look at the overall portfolio of the ECB. The red line is the Eurosystem bond holdings from the ECB website, and the blue line is HLP inflation. And what I circle here in green is the decisive time. So here we are now looking mainly at the large-scale QE type interventions. You see where the green, horizontal green line starts, inflation has moved above 2%. That was in mid-21. And you see that at that time, the overall bond holdings of the ECB were 4.5 trillion. 4.5 trillion, a very, very big amount. Now, and then these holdings, the purchases of bonds, mainly government bonds, increased from that time on by 500-600 billion more in the period where inflation moved up above 2% until around, I would say, around 8%. So this is the asymmetry, the problem once you start large-scale QE in a monetary union. It gets asymmetric. As when we started, we said, yeah, we use QE in the period where we had 2015, 16, 17, we had forecast and inflation was perhaps 30 basis points below the objective or 40 in 2-year time, and we used QE purchases to try to push inflation a bit higher. But then inflation did not go only 30, 40 basis points above 2%. It was 2, 3, 4 percentage points above 2%, but purchases did not stop, but they continued, which shows that the expectations created by large-scale purchases are very difficult to unwind or to turn around. You create expectations and the market has adjusted to, oh, the ECB will be almost always there, and then suddenly inflation moves up to 10%, and you cannot, you even continue to buy bonds. And in the period where the red line goes flat, remember, that means that is another almost a year, almost flat, means the ECB continued to purchase bonds during very high inflation for reinvestment. So it's not net declining. No? You see the red line is relatively flat in this green, second part of the green circle. Now move to fiscal. And John mentioned this. And to put it in a nutshell, there's a concern that fiscal rules worked all in all quite well, but mainly for middle-sized and small countries. And fiscal rules, apart from the big country Germany, for the large 4 countries did not work, broadly speaking. They did, and this is what John said, because it's France. You see here how the most stressed countries with very, very big difficulties, the small countries, Greece, Ireland, Portugal, and Cyprus. These are the yellow line on top. The average of their debt was 140 in 2013. And now, and this chart is not updated, sorry for that, because it's not updated, but they have now moved below the 4 big countries in debt to GDP. They had, yeah, you see, 40 percentage points higher debt 10 years ago. Now, if you take out Germany from the blue line, which is the big 4, so if you would only show the big 3, you would see that only the big 3 countries on average have now together even higher debt than the mostly hit smaller countries who all went through the tough EU IMF adjustment program have on average. Of course, Greece is still a bit higher, but Ireland, Cyprus, Portugal much lower. And another thing, another observation which tells you that possibly the fiscal rules in the monetary union do not work very well for big countries. Look at the blue line. The blue line at the bottom hovers around, 40 to 50% all the time. And it's who? All the countries who are not in the monetary union. EU countries outside the monetary union have the most disciplined fiscal policy on this metric over the last 20 years. And when the incentives are wrong, as for big countries as in the monetary union, fiscal rules do not really bite. You will get what you see in the blue line. That is the big problem because it is a big country. And you can see here the same with the primary balances. Look at the 4 EU IMF program countries who had a very tough time, who had a lot of burden on their society and on their people, which I certainly admit. It was not nice for the people to go through. But the people had to go through this difficult time 10 years or something ago because government debt was too high and reforms were not implemented before the crisis. Portugal, Greece, Ireland, Cyprus have primary surplus well above 0. And all the big countries in the last years well below 0, negative, so they have primary deficits. Italy only very recently moved towards 0. It's the same story. It seems that for the big countries, the fiscal rules do not really bite. Now the proposals. We aim with our reform proposals for something which can be done without a difficult treaty change. So no treaty change is required. One of the most important reforms is a powerful European fiscal institution, which really can take the decision, a fiscal institution, which can take the decision whether or not to bail out a country, whether or not to have an upfront debt restructuring, upfront. The decision of debt restructuring, remember, is taken by the country concerned. The European fiscal institution should have the power to say, we wait, we cannot give you money now, you are not sustainable, do your debt restructuring with your creditors upfront, and then we come in and help you. Some had hoped, myself, that the ESM would develop into such an institution, but that didn't happen. The ESM was even not used in 2022, but TPI was implemented. So we think a strong European fiscal institution, and importantly, it should decide not with unanimity. There should not be vetoes. There should not be veto possibility. They should decide like the IMF, and of course they need enough firepower. And then the second, of course, very important, completing the banking union. And this is nothing what the ECB can do. This is the lawmaker, the regulator. But most important thing is delink sovereigns from the banks. But as you know, in 2012, shortly before OMT was designed and Draghi said whatever it takes, the member states had promised, and that was in the first paragraph of a council communication, 2012 in the spring, we, the head of states, we will break the vicious circle between banks and sovereigns, 2012, and it never happened. It never happened. The regulation still today says, oh, if you buy government bonds as a bank, there's no risk weight. It's much less risky from the perspective of the regulator than everything else. And importantly, this is the regulator failure. It's not the central bank, the ECB supervision, because the supervisors don't make the rules. And a common European deposit insurance would, of course, be important. If all of this is in place, in the medium term, the ECB should no longer purchase any national government bonds, but only European debt. And European debt will be issued by this European financial institution, can be issued by the Commission, by the ESM. As a European institution or Euro area institution, the ECB should buy European debt, not national debt. And if national governments have a problem, the European financial institution will step in. This is more or less the conclusion. Looking forward to the discussion.
Thank you. When you read the book, it's not as passionate as as in the presentation of Klaus. So I found the book quite readable. I thought it was a bashing the ECB sort of book, but it's not the case. I want to say it's not the case. It's written in positive terms. Of course, Klaus, there is a lot of red and blue in your presentation. Fortunately, I was in a period where you put blues almost everywhere. But for my previous colleagues, under Jean-Claude Trichet and now current members, there is a lot of red, and I think that's a bit unfair, if I can say. I'm not a discussant, but I would like to say two things. I mean, first is that you have to put this in the context of fiscal dynamics in the world. I'm extremely worried about Japan, about the US, about the UK, and to some extent about France, because French debt is absolutely sustainable. It's a question, of course, of political difficulties, but the dynamics of the debt is quite different from some other countries like the US, for example, which I think is something you should put in context somewhere. The second point, I think, when you talk about the monetary union in the beginning, I think the biggest problem, one of the biggest problems in the monetary union, there are two big problems. One is the lack of completion of the internal market. I think you should have mentioned that a little bit more. That would have helped very much, in trying to have, perhaps business cycles within the monetary union, which are a bit more connected, than it has been the case. It's never always the case, but still, completing the internal market would have been. But the second important thing was the lack of banking union, I think, and the lack of resolution plans, and a preparation for a banking crisis. And I think a lot of things that happen after is really the consequence of this lack of preparation and institutions for, to manage, banking crisis. And it's not correct to say that international banks are lesser exposed. I'm coming from Belgium and being in the management team about the restructuring and of the Belgian banking sector. I mean, these banks were internationally exposed, and the local exposures were not the problem. Now, when you suggest, to have a diversified portfolio of sovereigns, I think, yes, you have a good point. Nicolas Véron and many others have made the point. Unfortunately, we not solve the problem. Because, these banks are very exposed to the domestic cycle. So if the government, has a big problem, the economy is going to get a big problem and the banks are going to get a big problem. So I think it's a bit simple as a solution. And on the TPI, Klaus, you're really on the TPI. First, I think you should put it in context. The Fed bought 1.6 trillion in a few days. And of course, the exit, and this is the important point, the exit very quickly. Look at the Bank of England with the LDI shock and the gilt markets. So I think this is now, the central bank interventions in markets, I think is considered, I mean, we have our views on this, is considered as standard. The question here is to articulate, and specify the conditions under which you do these things, and the conditions for credible exit. I think this is where we have to focus on. But the fact the central bank, the ECB, has a TPI is not per se something that diverges from what we see in all central banks nowadays. But I think, yes, there are question marks on this. I fully agree. We should talk about this. So I will give the floor now to first to Jean-Pierre. So Jean-Pierre is now at the European Investment Banks. He's a senior manager advisor, but I think it's important to remind you that Jean-Pierre has had important functions with 3 presidents of the European Council. So he has some experience, insight about, European policy making, and also as counselor to the ECB. He was my personal counselor during a number of years when I was at the ECB. So Jean-Pierre, welcome. And Lorenzo is currently visiting professor at the College of Europe in Brugge, London School of Economics, and senior fellow at Lewis in Rome, a well-known university. But it's important to remind you that Lorenzo has been chief economist and director general at the Italian Treasury between 2006 and 2015. So also we have 2 very qualified discussants. So Jean-Pierre, you have the floor.
Thank you very much, Peter. And thank you very much, Ernest, for inviting me today. And thank you to Klaus and John for their presentation of the mechanics of sovereign debt crisis, as well as for their reform proposals. Your book, I think, is clearly an important and insightful contribution to the long-standing debate we are having on European integration. This is a debate that started nearly 8 decades ago. So I think it's worth reading, and it's even more important, in fact, to take forward this debate, which I think is there to stay. That said, I would like to offer a handful of dissenting views, well, not to diminish the view or the value of your book, but actually to stimulate the discussion. And I will cover 4 topics in my discussion. First, institutional reforms. Second, the role of the ECB. Third, rules versus discretion. And then last one will be policy coordination challenges in Europe, in the European Union. So let me first address the issue of institutional reform. There, I beg to disagree with the authors when actually you lament the lack of institutional reform to strengthen our monetary union. This strikes me as a rather pessimistic view of the institutional progress that has been made during the crisis and afterwards. And just to recall, what this crisis, back more than 10 years ago, produced. Well, first, we had a significant strengthening of the fiscal framework. You mentioned the Treaty on Stability, Coordination and Governance, the so-called fiscal compact. There was a reform of the Stability and Growth Pact. I agree, this was perhaps not the greatest success, but defining effective rules is not so easy for a reason I will come back to later. The second thing, we had the establishment of the single supervisory mechanism and the single resolution mechanism, which are 2 fundamental legs, actually, of a banking union. Last but not least, we created a permanent crisis resolution framework, the European Stability Mechanism. So these developments, I think, raise 2 questions regarding the book's reform proposals. The first one is that what would actually a European fiscal institution devoted to debt crisis resolution add to what the ESM already provides or can provide? Well, for instance, the case of Greece has already proven that default is possible in Europe, in our monetary union. And in a sense, right, if the reform ESM treaty had been ratified by Italy, newly issued government bonds today would include collective action clauses. Conditionality is in place, and the ESM governing board consists of finance ministers who are representatives of democratically elected governments. Well, of course, we can make progress on decision making. This could be improved. Veto rights are not appropriate, but I think the core mechanisms are already there. So we have all the elements there already in place. Second question on this institution: why would the European Commission not be a viable candidate to assume the role of such a fiscal institution? because you don't mention that this possibility in your book. You want to create a new institution. In crisis situation, with the Commission in charge, decision could be made by qualified majority. And this was actually the case with the European financial stabilization mechanism that was used, for instance, in the case of Ireland and Portugal. So these are my two questions on the institutional reforms. Let me now turn to the role of the ECB. The book focuses very much on monetary union, but I believe it overstates the role and autonomy of the European Central Bank. Let me be clear, the ECB is crucial, extremely important in our monetary union. But even the most independent central bank does not operate in vacuum, nor does it enjoy full autonomy. Take, for instance, Mario Draghi's famous whatever it takes speech in the summer of 2012. Well, it would likely have amounted to mere rhetoric had it been publicly contradicted by leaders of major member states. Their implicit support, in a sense, gave the ECB commitment real weight. Moreover, and that you mentioned actually, Klaus, the June 2012 European Council, which launched actually the single supervisory mechanism and signals the political will to break the vicious circle between banks and sovereign, represented a material down payment on European integration. And that political backing, I think, empowered Draghi's words. Now, the issue of rules versus discretion, which is my third point. Well, this is a well-known argument in economic theory, and one that economists, I understand, favor. But I see limits to this view, to the view that rules are always or necessarily better. In a world that is continuously evolving, changing, and where we have actually little idea what the next decade will bring, the rules we write today may be perfectly suited to yesterday's world, but not to tomorrow's challenges. This is why I am convinced that a modicum of discretion must always be preserved. It's also why the quality of political leadership, the skills of policymakers, including central bankers, and the vibrancy of democratic debate are so pivotal to policy outcomes, especially when discretionary decisions are necessary to stave off new crises under uncertainty. So unlike the authors, I believe that the ECB discretion, for example, in deploying the transmission protection instrument is not only necessary, but it is beneficial. And yes, in fact, the ambiguity that comes with it, it's part of its strengths and also actually contributes to limiting moral hazard. My final point relates to policy coordination in Europe and the broad picture here again. In fact, the European response to the corona crisis, to the COVID-19 crisis, has shown that lessons from the previous crisis had been learned. Again, the ECB acted first, and it launched the pandemic emergency purchase program shortly after the crisis broke out. But then fiscal authorities, namely the governments of the Union, the European Council, and then implemented by the Commission, took only about 4 months to agree on a coordinated response through Next Generation EU. So the bottom line is that in a monetary union without a fiscal union, the main challenge will always remain coordination between the central bank and fiscal authorities in exceptional times. The central bank, as the sovereign guardian of the currency, must act first, and sometimes ahead of the political and fiscal backing that will be available more easily in a federal system. It has instruments that it can and should actually swiftly deployed in such situation of uncertainty and crisis. This coordination problem is a structural one in Europe. And it's a structural feature, in fact, of our process of European integration. And I think it will remain so for the foreseeable future, with perhaps some improvement along the road, building on lessons learned from crisis to crisis. But by and large, I trust first that the ECB has demonstrated its ability to navigate these uncharted waters and has done what was necessary to preserve the euro throughout all crises so far. So my plea is that until we truly move to a more federal structure, I would therefore caution against tying the ECB's hands with binding commitments, as the book suggests. That I would not recommend that. I would leave this modicum of discretion to the central banker in our political framework. I think it is very important for the future too. So to conclude, I think the book Crisis Cycle is thought-provoking, so I enjoy very much reading it. And I think, in fact, it's an indispensable reading for those that are interested really in European integration and to think through these issues. I thank you very much.
Thank you, Jean-Pierre. And the floor is to Lorenzo.
Thank you for the opportunity for me to speak at this event. The authors, this is a dream team, so top economists. And what really matters is what is presented in the introduction. So economists with different perspectives and experiences. And I think this is what really matters. And I wonder how they came out to a kind of consensus view, but it would have been nice to hear all the internal debates because that would have been a very nice stuff. But anyway, why another book on the euro? I mean, we have a number of very good books on the euro crisis and so forth. I came up with 5 reasons. First of all, it's better written and better organized than others, so it's just a better book. Second, it's a contribution to institutional reforms. Not many books make a positive proposal, so to speak. Third is it takes a long-term approach to problems, which is always nice in my view. Fourth, it looks at the interaction between fiscal, monetary, and financial stability policies, which I think is at the core of the problem. Fifth, it focuses on the incentive structure. I very much like the idea of the incentive structures, and I very much like the idea of the principles. So if I have to summarize the book, I would say the book says that there has been no cleanup between crises and almost nothing to unburden the ECB. The question is time to sort things out. Now, again, I fully agree with the incentive, the focus on the incentives and on the principles. I kind of disagree on the, say, transition and the implementation. So there are some problematic issues here. First of all, separation between monetary and fiscal policy has been blurred, first of all, by the effective lower bound. Central banks hit the effective lower bound on monetary policy, and that was the point in time, not just in Europe, that the two policies became a little bit blurred. Second, the doom loop, the problem is the transition as always. I mean, just to give you an example, the BRRD was properly designed, probably with good objectives, but poorly implemented, and I'll come back if you want. Third, sovereign defaults, as was mentioned, we got one, Greece defaulted, but keep in mind that before Greece, there was no default since 1950 of any OECD country. So no wonder that it was not an easy decision. Unfortunately, monetary union has been an ongoing crisis mode since its launch. Now, there is certainly a need to kind of unburden, the ECB, because the ECB has taken on board too many roles here. But the ECB is certainly important, but some of the roles were missing at the very beginning. For instance, the role of lender of last resort was really missing at the launch of monetary union, and we know it was very important in some situations. Most recently, we got problems in the UK. And the Bank of England stepped in. And the important thing, as Peter mentioned, is to design intervention in a proper way, but the need for intervention sometimes is pretty high. Now, I fully agree with the book that says that new initiatives to kind of fix the incentive structure and the institutional framework sometimes fell short. But as Jean-Pierre mentioned, we have to acknowledge that there have been many improvements over time. Now, I have a feeling, reading the book, but also reading, many debates in Europe, that Europe continues to have a sort of inward-looking attitude, which is present also in the book, so to speak, and we tend to kind of dismiss or forget that the world is moving and it's moving fast, and Europe is losing out, and that's why probably some of the problems highlighted in the book can be summarized saying that Europe is still too fragmented and too slow to act. So it needs to be something needs to be done quickly. Now we have another existential crisis, which is the combination of Russia, Trump, and the global South that is challenging. They are challenging the existing status quo. But is Europe prepared for these challenges? I would say no. Okay. There is a big risk, in my view, and the tendency also by European citizens to say, okay, Europe is a democracy, it's too slow, it's too fragmented, and it's not working as quickly and as efficiently as other countries that maybe have less democracy. And so there is clearly a risk that many voters tend to kind of move to far right or maybe far left. So non-democratic solutions for problems that can be solved in a democratic way. And I think this is the big risk for the future. Just very quickly, 3 examples. First of all, as I mentioned, the blurring between monetary and fiscal didn't happen by accident. Actually, it was the global financial crisis that first caused this. I mean, this is what is in textbook called deflation trap. And I know that maybe some of the authors might not fully agree with the new Keynesian fiscal, the new Keynesian framework, but this is a textbook example, and which never happened before. But I think the global financial crisis was a big shift of the IS curve to the left. And in order to address the challenge, there were only 2 solutions: either big fiscal stimulus, which clearly could not be done given the crisis and the problems of fiscal policy across Europe, or some kind of intervention by central banks to kind of move below the effective lower bound, so effectively quantitative easing and other measures introduced by the ECB. And I think that was the point in time that the book doesn't really mention, that actually there was a blurring between fiscal and monetary. Now, of course, in Europe, there is the extra problem that it's not a country. So if you buy bonds, you buy bonds of national countries, not of European, or European government. But in my view, there is probably an easy way. I wrote a paper with Paul van der North a few years ago. If you issue a safe asset, a European safe asset, and you swap national bonds in the portfolio of the ECB with a safe asset, you immediately free the central bank from the link with national governments, and then you can actually accept collateral only on safe assets, and that would solve many of the issues that you highlighted. But again, this is not, we are not yet at that point, and so we have to live with the situation. Second point is that there were some policy mistakes. Now, first of all, again, I mentioned no lender of last resort at the beginning, and sometimes it is useful and needed. Again, Bank of England, not long ago. Secondly, the ECB was slow to react in terms of lowering interest rates and introducing quantitative easing. And the result is that was slower than the Fed, and the output gap, which is the gray area in this graph, go much deeper into negative territory and stay there for a very long while. The ECB at some point even made some mistakes, increasing rates, okay, while the output gap was still deeply into negative territory. And of course, fiscal policy was probably tightened a bit too much and too early. So I think there were also policy mistakes, and it's not just the institutional framework and the incentive structure. Finally, the situation. On the horizontal axis, you can see a forward-looking measure of debt to GDP, which is taken using Commission data. And on the vertical axis, you see the adjustment that is needed to stabilize the debt to GDP ratio when you have a shock of 2 percentage points between the difference of real GDP growth and cost of borrowing. Now, what is the bottom line here? If you take the Commission forecast back in 2020 and now the latest spring forecast, you see that there has been a decline in terms of debt to GDP in the periphery and an increase in some core countries. Now, if the increase comes from Germany, it is welcome because it means that it can actually offset some fiscal tightening in the periphery and provide a fiscal stance for the whole of the Eurozone, which is good for the economy. But of course, you have the problem of France, but not only France. You see, Romania is going, the debt dynamics is going pretty badly here. But within the Eurozone, there is also Austria and Finland that are not moving in the right direction. So basically, what I'm saying here is that it's no longer, as it used to be, a problem fully of the periphery nowadays. And I think probably we should move on, take more interesting challenges that we have today. Finally, the point, as I mentioned, is are we still fighting yesterday's battle? Because I have the feeling, a kind of deja vu feeling, discussing this stuff. We have been discussing these problems over the past 15 years. And what is the most pressing issue today? It's not fixing the fault lines. Yes, it is important. Improving the institutions, improving the rules, improving the incentives is certainly very important, but we need to move forward because, for instance, we have now the Draghi agenda, which my take is that is not implemented with the speed and the intensity that would be desired. And now we have big challenges like Defense and Security Union, and probably the big of all is institutional reforms. So we need to move forward. We need to move quickly into the direction of these reforms. And we are still discussing kind of old issues here. Now, I think Europe is already probably beyond the point of irrelevance. And certainly when Zelensky is told by Trump, you don't have the cards, the same applies to Europe. Europe doesn't have the cards today. And so I think it needs to move fast to become relevant and become an important actor at the global stage. Now, I tend to kind of disagree with what John said at the beginning, that monetary union is a sustainable statement. I think over the long run, it's not. In other words, either you kind of integrate the economy, you kind of strengthen integration, or at some point the situation is going to become unsustainable. And I think Europe is not moving fast. So Europe is still in the middle and needs to do a lot more to integrate and move faster towards probably political integration, because that is at the core. And we have seen recently that without this kind of speed movement towards political integration, situation might become increasingly difficult. And the geopolitical challenges that we have today within Europe and outside Europe are here to tell us that something needs to be done.
John and Klaus, you want to react? There was this question of safe assets, which I found interesting.
I'll make a couple comments. Thank you. Those were great and very thought-provoking comments. For Jean-Pierre, I think we can, the ESM, we can be kept, revived, and used. Our real criticism was that it was put on the shelf in place of TPI. It raised the great question of rules versus discretion, and this is the fundamental problem. If we can, we will bail out, all of us. When the crisis comes, you will bail out. But then, of course, we know when everybody expects a bailout, you have horrible incentives ahead of time. So the only way to stop that is to commit ahead of time that you won't bail out, but then you'll regret that in the end. I think that the delicate balance is, Odysseus tied his hands behind the mast, had his hands tied behind the mast to not listen to the sirens. Well, you want those ropes to be loosened up so that if the ship starts sinking, you can get out of them. And that's a delicate balance. I agree. Second, the TPI thing, I think there is a larger issue here. And I think Klaus really hit it with the way that the ECB and the TPI is making political decisions. We have said for 10 years, many of us have said, oh, do this and you'll lose your independence. Do this and you'll lose your independence. Everyone goes, yeah, don't worry about that. It won't happen. Let me tell you news from the US. 10 years, we are right now in the fight of all times over Fed independence. Mm-hmm. This can happen. This will happen, and it happens like all crises when you least expect it. And it's happening right now in the US. I think two aspects are important here. One, to gently criticize the ECB, not only is the fact that it's making political decisions in the TPI, but the language. We are in a period of loss of faith in many institutions. And the ECB isn't helping by the convoluted language it uses to defend TPI. We know what they're doing. They're buying bonds to keep spreads from rising. No. This is just our price level mandate, but markets are fragmented and dysfunctional. Everyone can see through that. And that's not helping in the kind of faith in institutions that is the bottom right line for independence. Last, many of you are bringing up points that this is all yesterday's news, and in many ways it is. We're mostly thinking about individual countries having fiscal problems within a solvent union. Maybe the union itself is no longer solvent. The same thing is true in the world. Now, around the world, as you mentioned, in 2021, all of our governments spent money like drunken sailors. All of our central banks bought those bonds, and we all got inflation as a completely predictable result. Enough fiscal stimulus, you get inflation. Thank you. And we are now heading into, I think, a danger, as you mentioned, of all the advanced countries having together sovereign debt problems. And that's not what we were thinking, more about individual countries, not what happens when they all together. And this is really the monetary independence question that will face everyone around the world if it gets worse. And this is happening in the US right now. The argument between Trump and the Fed is, I want you to hold interest rates down in order to reduce the interest payments on the debt. That's what happened in World War II. That's what happens in Latin America when they start having fiscal inflations. That will be the pressure in Europe. The kind of monetary independence you're asking for is, does the central bank have the power and the will to say to the government, no, we're not monetizing your debt. You will either reform or you will default right now. That's a tough kind of independence, but that really is the worldwide question, not just a question of a monetary union. And last, we said a lot of nice things about next gen, but I think that is the heart of the problem. Yes, Europe jointly borrowed some money, but Europe threw that money down rat holes, such as the wonderful Italian super bonus, which is a great example of rat holes. We got to stop borrowing money and throwing it down rat holes, even if we have borrowing capacity.
Thank you, John. Klaus?
Thank you, and really great questions. Peter, you mentioned TPI or other asset purchasing instrument. The credible exit is needed, but this is exactly a very difficult thing. And as you have seen, what I showed from inflation going above 2%, we had no credible exit in times, even when inflation moved towards 5, 6, 7%.
That was not market sorry, Klaus, that was not market stabilization. There was a mix, but
you create expectations. Why didn't we sell that? Right, okay. But then there's a very important point which Lorenzo made. Yes, the Eurosystem buys bonds from individual national countries. The Fed mainly buys centralized treasury bonds from the United States central government. That's a big difference in terms of dynamics and incentives for individual players. Jean-Pierre, Yes, I mean, you certainly, the book is about monetary fiscal, and what Jean-Pierre and what Lorenzo said, yes, we need, of course, the single market to make the single, and Peter, the single market is a very, very big thing. But it has the responsibility of the Commission, but it has not happened. And our co-author, Louis Garicano, has made very clear points that this is a big problem on the single market not moving forward. Yes, on Lorenzo, yes, we say, many people say we need to move forward a lot in political union, fiscal union direction. We are not discussing this in detail. We thought this is so difficult to get unanimity.
We lost you.
We lost you, Klaus. Please switch on.
Let's do what you can fix without a major change, with a change of the treaty. A number of proposals you are making or others are making, you need a treaty change, you need unanimity. That's even more difficult than what we suggest in terms of political procedure and getting there. And Jean-Pierre, I think it struck me a bit. You said the central bank, yes, is not in a vacuum, but then you defended that the central bank takes, say, decisions which are close to fiscal policy, which are close to political decisions, and gets an implicit, as you said, an implicit agreement from, say, Merkel or Sarkozy or Monti at the time of whatever it takes. They are not criticizing, they are saying, oh, it's okay. But what is this? You that perhaps in terms of democratic accountability, that's the key issue. What you possibly that what Schäuble wrote before he died and his book is published, where he said he complained to Merkel that Merkel, it was 2010-11, that Merkel was silently behind his back giving green light to ECB bond purchases. I'm not sure it was whatever it takes, it was a bit before perhaps S&P or what. And then Merkel answered, according to the finance minister at the time of Germany, yes, but I don't want to go into my party at the Bundestag. I don't want to go in the parliament and have all these discussions. But you know, what you're saying, implicitly agreement from the leaders, yes, but that needs to be transparent, and there needs to be a body who does this. It cannot be behind closed doors that Merkel says, I don't want to discuss these things in the German parliament or somebody else in the national parliament, and then does it behind closed doors with the ECB, and is a political decision. That is going into the question, what is independence and who is independent from whom? So I really think we have to think about this issue. I'm not against that there are some limits to the central bank, and the central bank sometimes may act as a fiscal agent. But please then make it transparent that the electorate doesn't get frustrated, as somebody mentioned, more and more non-European or populist, whatever parties. Make it transparent. We have the European Council. We have a joint decision that this is a fiscal agent activity of the central bank. It's not a monetary policy activity. And then we have a clear, transparent political decision. But that is exactly not what is happening. So that's my concern from a democratic accountability point of view. And now my last remark, yeah, it goes also in the direction of discretion and ambiguity. I think that leads too much to political decisions, to the central bank, which has these instruments and is discretionary thinking about political issues, but not transparently, as John said, making clear what they are really assessing in detail. Yeah, and Lorenzo on the Europe is too much inward looking and so on. We thought that having John on the authors ensures some outward, somebody from outside the Euro system, the Europe, and of course we have. It's true that we are not talking about single market and reforms a lot, but we make very clear I think in the introduction that we are not claiming that monetary fiscal issues are the most important thing for the future of Europe, of the welfare and so on. There are many other things, but we already needed almost 300 pages to talk about monetary fiscal. So it was a bit difficult to also talk about the things which rightly were mentioned by Lorenzo and others on defense union and so on. Certainly these are important things, but it doesn't help to say the last word. If you don't fix the fault lines and they come hinting you and they come hitting you, maybe it's even more difficult in such a political environment to do what Lorenzo you suggest, and I personally also think could be very, very important.
Just
I think, Klaus and John, you're right. I mean, there is a sense of urgency, and what I liked in the book, you say, every time you think when there is a big crisis, you think, you have time before the next one. And then the next one came very quickly with the COVID, and then we had the Russian issue. And then you mentioned, China, Taiwan, some of, horrible scenario that you describe. And so you say, you have to act urgently and not wait, because the next crisis may come very quickly. I think that's very important. And we have this issue that you mentioned, that our democracies have not been very good, in acting very quickly. And Jean-Pierre, the process, how difficult it is to change institutions, but we don't have much time before the next crisis. I think this is interesting to read in the book. It's well written, actually.
I just want to close up on this, the political union question. More political union and more fiscal union may or may not be desirable. More economic union is certainly desirable.
Absolutely.
Turns out the implicit tariffs are still very high between European countries. So political and fiscal union, I think the US has too much of political and fiscal union. We all run to Washington these days for things that should be done at the state level. So don't give Brussels too much. But our central point is whether or not that's desirable, you don't have to do that to have a monetary union. We can all use the meter safely ensconced in Paris as the common unit of length, and we don't have to have a political or fiscal union to do that. In the end, monetary union is the same thing. We'll have one standard of value, one unit of currency for the whole area, and you can do that without with the political or fiscal union, whether or not those are desirable. And that, as Klaus said, that's our point, is to do, what's the minimalist thing, not require things that aren't going to happen soon.
Jean-Pierre?
Thank you, John and Klaus. I mean, I think you are right. I mean, one of the difficulty in this question, of course, is that you always have to approach, in fact, this kind of issue from a specific angle. So you take, monetary policy, fiscal policy, and then there is politics, there is economics, and very often, in fact, it's very difficult to disentangle that. And to conclude, my point is that in Europe, one of the difficulty, of course, is that we have assigned the responsibility, the sovereign responsibility for the currency, for monetary policy, to an institution that is independent. So in fact, in a sense, that's a responsibility of general government. In the past, that was assigned to each government. It has been mutualized and given to an independent central bank. So naturally, given that there is no fiscal counterpart that is, let's say, functioning in a federal way, if you wish, there will always be this tendency for the ECB that has this power, in fact, this sovereign power in times of crisis, I mean, to try to do something. And in fact, to my view, it has to do something because you need to gain time for this complex political process that we have in Europe, and that, of course, can be criticized in many respects, but this is what we have so far. To come to an agreement and to come to some sort of solution. And my point was just that in the sovereign debt crisis, it was clear that it was a very, very bumpy process, very lengthy, and that was part of, let's say, the political history, in fact, of our union. If you take the more recent crisis, I mean, it was a bit of it's not the same crisis, of course, but this was a repetition where, in fact, I mean, there were a number of factors that were helping, in fact, this coordination, the fact that everybody was hit more or less at the same time, it was a common problem and so on and so forth. But still, I mean, the countries, the member states managed to reach a unanimous agreement in 4 months. And I think this is something that is rather positive. Whether or not the solution was the best one is another issue, but I think it's rather positive in terms of political processes. And
it's more difficult on structural reforms, Jean-Pierre, but
just one final remark then to what Jean-Pierre said. It just reminded me, you asked the question, why not the ESM? And as John said, our main concern is it has not been used. So we want an institution which is powerful enough, also in terms of financing, that they can, if needed, bail out a large country, and that it's, everybody knows this is a powerful institution. They can make swift decisions without unanimity, and every government knows if they have a fiscal problem, we don't turn to the ECB, or we don't expect the ECB to intervene, but there is this democratically legitimate, clear fiscal institution, and they make the decision. And the ECB is not involved in such decisions, as I said, are political of nature. For instance, the ESM, as a last remark, they even don't have what the IMF has, Article 4 missions. They cannot go every year to the countries and see, are things developing in the right direction? Do countries have a problem with debt or with structural policies? The ESM is, and it has been seen, member states don't want currently the ESM being kind of active in a crisis. They hope it's the ECB. And therefore, we are saying either a very much enhanced ESM or a new European fiscal institution. The problem with the Commission is, I think it's a treaty change, a very big treaty change.
Ernest, there are many comments I see.
I'm happy to provide a brief summary of some of them. So maybe if the speakers are willing to cover some of them. So we have quite a couple of comments by Lorenzo Binismaghi. Hi, Lorenzo, very good to see you. Lorenzo, for instance, draws our attention to the issue, what happened during the same period that John and Klaus described elsewhere, for instance, in the US, in the UK and Japan. So the question of the benchmark, how to judge developments in Europe. Then Lorenzo also emphasizes that the TPI is conditional on debt sustainability analysis. So it's not just purely discretionary. Then Lorenzo also points out that QE was not the real problem with a lagged monetary policy response, but it was negative interest rates. Then he asked the important question, should Italy and Spain, in your view, Klaus and John, have restructured their debt in 2011? And what would have been the implications for the union and for the financial markets? Also, if we look at towards the US, in the US, states can default or restructure because there is a strong central government that can absorb the impact. This is actually not the case in Europe. Then I want to also draw your attention to Claudio Borio's remark that for sure fiscal authority and restructuring rules are understood and may even have been conceptually identified already when the treaty was drafted, but is there the political will for deeper integration? What would it take to get it? Some lack of it, some lack of will that has held back the creation of a true internal market that has just been mentioned 2 minutes ago. And then there is also comments by Giovanni Radicella regarding the TPI. Giovanni asked the question whether, for instance, one might operationalize it, make it more concrete by, for instance, creating a sort of target zone around, spreads. So defining ex ante what a critical spread would be. I just recall that we had this discussion at the ECB, and we in the end we didn't go for it. But maybe you have a view on this as well. Franz Nauschnig reminds us that also other countries, like was pointed out, the US, the UK, have instruments in order to reduce spreads when there is a market unrest. But we just discussed last week that actually these types of instruments are quite different because they are very limited in nature and have an explicit financial stability aim. And finally, Hassan asks John about the compatibility of the argument in the book. One of the central ideas of the fiscal theory is that monetary and fiscal policy jointly determine inflation. Now, if this is the case, why then does the book argue for a separation of both policies? So this is just a short version of the questions. Maybe you can cover one or the other in the remaining minutes that we grant ourselves.
Five minutes. 5 minutes.
Wonderful questions, and we could spend a long time on all of them. Let me just, there's a question about U.S. states. Since I'm the American, I'm supposed to know something about that. No U.S. state has defaulted since 1830, and we'll see what happens if one threatens to default. So I'm not sure that that is a good parallel, that we just have the federal government to absorb all the state debt. State debts are not held with zero risk weights by banks, which is a useful feature that maybe Europe could use. The TPI I think is a central thing. You know, could it be made more concrete? Could we publish some rules about which spreads are due to fragmentation and market unrest and market dysfunction versus fundamentals? No, and this is the central problem. If you knew how to tell market fragmentation from fundamentals, you would be insanely rich, because that's what every hedge fund in the world is trying to do at all moments. I do sense among central bankers a great distrust of markets, and you know, markets are, sometimes it's fundamentals, guys. Not every untoward rise in spreads is due to dysfunction. And if it really is market dysfunction on a regular basis, shouldn't we be fixing the markets rather than jumping in to buy bonds at the slightest hiccup? So I think that's, while that's a lovely sentiment, I think the whole point is that is difficult. And really central banks should go back to being able to say, there's things in my mandate and there's things not in my mandate. And my mandate includes limits on tools. I'm not allowed to give a general put on stock and bond prices, which is pretty much where we're going. I'm allowed to think about inflation and the short-term interest rates, and markets go where they go. That's part of the pre-commitments to not intervene in things. And the US Fed, now this is true around the world. The US Fed issued a Mario Draghi worthy whatever it takes, and there weren't even limits on it on corporate bonds in 2020. So once you take on responsibility for something, you have it forever. And finally, yes, monetary and fiscal policy are always joint, but the separation of institutions is a very important pre-commitment. And what it achieves is that good fiscal policy borrows. Borrowing is a wonderful thing. When you borrow in order to meet a genuine emergency, you spend it wisely and you have a plan for paying it back. That's great. And the separation of monetary and fiscal policy allows fiscal policy to do that, which means then fiscal stuff doesn't cause inflation. So separating institutions is a great way for a joint effect to be made wisely.
Should Italy and Spain have defaulted in 11? That's not the question I can answer. Our answer is it should not be the ECB to decide this. It should have been member states via the ESM was created a bit later, and then collectively they should have decided. Remember what happened in 11. First, S&P was buying bonds of small countries, Portugal, Ireland, Greece, and in 11 spreads moved up for Spain and Italy, and we started to consider buying bonds in Spain. And then the president of the ECB, wrote a letter to the Prime Minister Berlusconi and to the Prime Minister Zapatero, and the letters were signed, logically I would say, by the governors of the two central banks, Mario Draghi for Italy and Governor Ordóñez for Spain. And these letters were small programs. These were conditionality programs like the IMF would do it. But is this, Lorenzo and all colleagues, is this really the task of a central bank? I was myself involved at the time. You know, I was head of EU country division and was deeply involved in all this. And I understood the logic and I contributed to this. But thinking and looking back, this should be a fiscal institution, a European fiscal institution, of very, very much stronger and more credible ESM, and not a central bank which is not accountable directly to the European Parliament or to parliaments as we know. This should be in the hands of governments and fiscal authorities, such letters or such considerations.
So thanks a lot. This concludes our Meet the Authors SUERF-Baffi Bocconi webinar on crisis cycle, challenges, evolution, and future of the euro. Thanks to Klaus and John for your excellent summary of key findings from your new book. I think we can draw the joint conclusion that this book is definitely worth a read. It stimulates a huge discussion both among the speakers and in the chat, as you can testify, everybody. Thanks a lot to Jean-Pierre and to Lorenzo for your really thoughtful comments. One really sees that you went deeply into the book and had a thorough thinking about it, and to Peter for your smooth and professional moderation. It has become clear to me that the rich history of the euro, its successes and its crises, can lead to quite different conclusions depending on your perspective. At the same time, there is also a lot of important common conclusions on key aspects. Euro's founding architecture was incomplete in one way or the other. We actually couldn't get agreement in what way. Successive crises forced the ECB into extraordinary interventions, raising concerns about blurred fiscal monetary boundaries. Institutional adaptations have indeed been made, so the EU has shown some, capability to reform itself, to develop further. But there remain questions as to whether these reforms are fully incentive compatible, whether they didn't even exacerbate some incentive problems. And there seems to be the notion in the panel that we are not yet in a situation which grants sustainable stability for the euro. And I think there's also a sense among several speakers here that Europe risks fragmentation and loss of credibility if further reforms are delayed, especially amid shifting global power dynamics. Europe simply cannot afford in the new world order not to solve its problems. I think with this, let me conclude today's Meet the Authors lecture. Thanks again to our speakers for your excellent presentations, for the lively discussion, and to all of you for participating, for your interest, and for your thoughtful comments in the chat. Thank you. Bye-bye.
Thank you. Bye.
Thank you.